And you said that portfolio balancing is a waste of time. So what are John and Sally Doe supposed to do?
Depends how much money you have, right? So the best way to get a return, let's just say you have $50,000 in cash. It could be 10, it could be 100, but let's use 50. The first thing I would do is pay off all your credit cards, because that's costing you 18%. That's what John and Sally should do first. Most don't, right? There's more credit card and student loan debt relative to personal income than there's ever been in the history of the United States. Second thing you do is you use the transactional value of cash. A lot of people say, you're losing money to inflation when you just have cash in the bank. I completely disagree. I know I'm going to be buying a bunch of toothpaste for my family. I know toilet paper. I know all the consumables that I have. I can take my cash and go get a better value. I can take my cash and go buy service.
Store up?
Yeah. Yeah, why not? I mean, how much space does toothpaste take, but you're going to spend. But that's the whole thing. The time it takes just to figure out your budget, which nobody does. The time it takes just to analyze your spending habits, you can get a better return and you'll end up with more cash than trying to fight the John Paulsons of the world and these guys who have hundreds of analysts who are working for them. Why would you try to do better than them?
You can't win.
You can't. And now it's 100 times worse because of all the program trading.
But if you have enough money that you have to put some of it somewhere, to park some of it somewhere and hope to make a return on it, where do you put it?
What I do, I don't think you have to make a return on it, because I'd rather sleep well at night. I put it in cash, literally. Now, obviously, I'm in a different position where I don't have to live off of the interest paying me 1 basis point off of cash, right? But at the same time, having that dry powder, if you will, available when weeks like today or weeks like this week hit and days like yesterday and today
and you see an opportunity.
And you see an opportunity, then you're ready to take it, as opposed to saying, I can't get out, what am I going to do? And I'll tell you the other part that's better, you're going to cut your health costs because you're going to sleep a whole lot better at night.
Do you sleep well?
Oh, I sleep like a baby.
Ted Williams wrote a book called The Science of Hitting, and in it he had a picture of himself at bat and the strike zone broken into, I think, 77 squares. And he said if he waited for the pitch that was really in a sweet spot, he would bat 400, and if he had to swing at something on the lower corner, he would probably bat 235. And in investing, I'm in a no-called strike business, which is the best business you can be in. I can look at 1,000 different companies, and I don't have to be right on every one of them or even 50 of them. So I can pick the ball I want to hit. And the trick in investing is just to sit there and watch pitch after pitch go by and wait for the one right in your sweet spot. And if people are yelling, swing you bum, ignore them. There's a temptation for people to act far too frequently in stocks simply because they're so liquid. Over the years, you develop a lot of filters. And I do know what I call my circle of competence. So I stay within that circle, and I don't worry about things that are outside that circle. Defining what your game is, where you're going to have an edge, is enormously important.
You need to try your best to buy the real estate you're doing business in as quick as you can, no matter how small the space is, whether it be a store, an office, a kitchen. You can control your business better if you're not giving the profits to the landlords. I opened 20 offices building my business, and out of those 20 offices, I bought 3 buildings. And when I sold my business for $66 million, those 3 buildings were worth more than $66 million, simply because I was smart enough to buy them.
My mother, I was born in Montreal, worked at a company called Kitty's Togs, and she used to come home and tell my brother and I, because they'd pay them every week on Thursday mornings, she'd always invest 1/3 of her paycheck into Bell bonds with coupons. She'd always say to me, boys, never spend the principal, just the interest, and never, ever, ever, ever buy a security that doesn't pay a dividend.
Right.
And back in those days, stocks paid higher dividends than the bonds. So example, Bell Canada had a 6% yield on its 5-year paper, its bonds. The stock yielded 7 to entice people to take the risk to own an equity. And we got lost somewhere between the 50s and the 60s and 70s, and we actually thought that it was a good investment to buy a stock that didn't pay a dividend, which to me is insane. So anyways, I wanted to found a firm on that, my mother's basic concept, because she died a few years ago, and I was executive for her estate, and I looked at her portfolio, which she never shared with anybody, but 40 years compounded dividends and bonds. 73% of the market's returns over the last 40 years came from dividends, not capital appreciation. And she knew that intuitively. So that's how we built the foundation of O'Leary Funds. We listen to Mom. We don't own a single security that doesn't pay a dividend. I will never buy a stock in my life that doesn't pay a dividend. If it's not returning cash to me, it's a speculation. And if a manager can't send me cash, I'm not interested.
You guys have an extraordinary track record of winning.
Yeah.
Is it harder to compete in the markets today than it has been since you founded Bridgewater?
No, I don't think so.
Really?
Not the way we do it. And the reason I'm saying not the way we do it is we don't take systematic biases. I think for a lot of people, they're systematically long everything, you know? And so we have a world in which when the world gets bad, it's bad for them. In 2008, it was great for us. I don't know, we had nearly a 10% return in 2008. So we have the opportunity to go either way. We just may be wrong if we're wrong. So I'm so scared about being wrong that it has helped reduce my chances of being wrong because I'm so scared. I won't take bets that that I don't feel good about, and we diversify our portfolio, and that's how we have the track record. I was just commenting in terms of,
I see.
Let's say, you asked me about investors. So I'm trying to go back what an investor should do.
Well, and what you think is appropriate for your
here's
investors, what you guys are doing.
Well, I want to just convey to investors. I think in the average investor, most everybody, don't compete against pros like ourselves or other people. Don't making tactical asset allocation bets or moving around in the markets because you're probably going to lose. It's difficult for us. We put hundreds
just buy beta for 15 basis points?
No, you have to have a balanced portfolio. In other words, think about how you're going to have a balanced portfolio. What you know is that asset class as a whole, over a period of time, are going to outperform cash. Mm-hmm. Okay, that's the most thing that you could be most comfortable with. If they don't, you have a depression. The only times that hasn't happened. But to know how to achieve a balanced portfolio, and that's a whole other subject I don't know that you want to go through. If you're talking about tactical bets, in other words, I can come on the show and I can say, I think this is good. But then what happens is if I come a month later and I then change my mind because something has happened, then I'm going to mislead people. So the tactical bets I don't think are going to be helpful. I would say that we're in an environment in which it's very important to have a well-diversified, and that'll include assets like, to some extent, maybe a little bit of gold in your portfolio. In other words, what could I tell investors? Try to achieve balance in various ways. That's a whole subject about how to do it. And also, I think that, gold, at 5% of your portfolio, 5 or 10% of your portfolio, under the circumstances, would be also a prudent thing to do. Prudence is the important thing to do. The reason I'm also referring to that is we have a situation where a debt is money. In other words, we have a fiat monetary system too. And so we're having problems as these central banks operate. And so think of it as another form of cash. And when cash now has 0 or 0% interest rates or less, think of it as one of those possibilities in terms of how do you create diversification? We break it into two parts. We have two basic portfolios. There is the strategic asset allocation mix, which we call all weather, and that just has nothing to do with bets. It has to do with how to make all the assets the same risk parity. I would call risk parity. The problem is when people try to diversify and they own some equities, and equities has a volatility that's large, or they own assets that do well when the economy does well and do badly when the economy does badly, they have a concentration of their risk in some assets. Right. They need to change the portfolio. They need to buy longer duration bonds or leverage the bonds or bring up so that bonds and commodities and pieces have comparable impacts so that whatever happens in the economy will then have a balancing effect. Because the one thing you could be most confident is that asset classes on average will outperform cash. Okay. So if you have, that's a strategic asset allocation. Mm-hmm. That's what the all-weather piece is. Then there's the bets. The bets are zero sum, right? In order for you to beat me in the game, you're going to it's like poker. It's a zero sum game. We have 1,500 people who work at Bridgewater. We spend hundreds of millions of dollars on research and so on. We've been doing this for 37 years, and we don't know that we're going to win. In other words, we work that. We have to have diversified bets. We have a lot of diversified bets and so on. So it's very important for most people to know when not to make a bet. Because if if you're going to come to the poker table, you're going to have to beat me, and you're going to have to beat those who take money. So the nature of investing is that a very small percentage of the people take money, essentially in that poker game, away from other people who don't know when prices go up, whether that means it's a good investment or if it's a more expensive investment.